Cool. Welcome everyone to the panel on tokenization. I'd like to introduce to the stage JP from Mantra, Justin from Ondo, and Carlos from Securitize. Dude, groovy.
Got a panel. Yeah, we got a crowd. Wow.
Cool.
All right.
Good morning, everybody. How's everyone doing? Good, nice. Yeah, on the stage here, we have some amazing folks, some builders in the tokenization and real-world assets space. We're going to keep it really, kind of conversational style. It's 45 minutes, and so we can kind of, just let the conversation meander to wherever we want it to go. So for the very, we'll keep it simple for the very first question. We're just going to get into, what is a tokenized asset? What are real-world assets? I feel like, a year ago, no one really knew, and today I feel like many people do, but I'd love to, establish that very baseline level of understanding for people, so. Yeah.
Should I go first? All right, so first, tokenization just means, issuing a token on a blockchain that represents ownership into something, right? So that's what a token basically is. When you talk about tokenization of real-world assets, you're basically implying that that token confers some sort of ownership or economic interest in the underlying asset that you're trying to put on chain, right? And typically the way you do it is twofold. Either you take something that is an existing asset like a dollar, so stable coins probably is the largest example of tokenized asset, or a security like a fund or some sort of other financial instrument. Or you take like a real-world asset, and then typically to provide fractional ownership into the asset and economic interest, you securitize it. So you also turn it into a security that provides the economic interest of the underlying asset into the token. So,
and just to maybe add a little bit on that, I think we've seen over time like different flavors and different acronyms. And Carlos is an OG, so he knows like RWAs are the hot thing now. It was STOs previously. I mean, it's all just a different wrapper around, exactly that.
It's the same.
It's the same. It's the same thing. But I think it's pretty important to kind of get the understanding that the actual token creation part of this game is not the hard part. Like spitting out a token, whether it's an ERC20 or in our case we're building on Cosmos SDK, is really not the hard part. The hard part is actually conferring and translating the real world rules, rights, economic requirements back into the token form and actually making there like a legal structure or legal pathway between the real world and the token. Because spinning up an SPV, creating a token that has representation of the shares is fine, but that's not real true tokenization in my opinion just yet. And we're going to unpack that a little bit more. But I think in due course we're going to see a lot of different ways that like actually have a really seamless transfer of value between on and off chain asset classes. So. Yeah.
Cool. Getting a little philosophical pretty early on there.
Of course.
For early, we got it in the morning.
Yeah. Hope everyone's had their coffee.
So what is what's the point of doing all this stuff? Like what are the benefits? I'm an investor. Why is this token that's on a blockchain better than me going to my Schwab brokerage or any other traditional venue?
I mean, I can jump in. I mean, I think it really does depend a little bit on the asset, right? And like why you're tokenizing it. There's like promise of democratization of asset classes. We were having a little bit of a conversation about that earlier in the speakers panel with Meltem, and she was not a big fan of the word democratization, but from this perspective. But democratization or access is one thing. Mantra particularly is based in Asia and in Dubai primarily, so Middle East and Asia. And a lot of the people in these parts of the world legitimately don't get the access to products like being here in the US. So access is one thing, fractional ownership is another. There's a lot of different reasons. The promise of liquidity, I don't think we've really solved that yet. So all these things are reasons why you would want it in a token form. Accounting and bookkeeping is another one, record keeping, cost savings. But I think some of these things are still promises. They're not necessarily fully in practice, in production yet.
I just want to say something more basic. So if tokenization is basically a digital way of representing ownership of something, that means somebody needs to have a ledger saying who owns what, right? And a blockchain is just a ledger. It's a very good ledger that is, decentralized, is cryptographically secure, is public, is well available, etc. But at the end of the day, it's just a ledger, right? So if you want to represent ownership and being able to, transfer ownership in an efficient way and record keeping of who owns what, and that might lead to other advantages like liquidity or other things, or a better fractional ownership, you need to have a digital ledger, and a blockchain just happens to be a very good digital ledger that was designed to transfer ownership, right? So to record and transfer ownership.
Yeah, I guess just to add to that, I think the most basic thing is you actually have to use the tokens. Like if you just tokenize something and then it just sits there in token form for 7 years and then
it's pretty cool.
Matures, it's that was stupid, right? Yeah. Like you really actually need to use the on-chain machinery. Like everybody's talking about RWAs, everybody's talking about tokenization. That's very exciting. We can sort of see where the world is going. But really, if you're not using the tokens with the actual machinery of on-chain protocols, called DeFi, call it whatever you want, then really you don't really need to tokenize these things. You can use something that's a pretty standard process if you're not actually going to use the on-chain machinery. You definitely get some benefit from market access. We see that with our own products. I think there's some element to that, but very much the on-chain machinery, like by far and away, the product that has the most product market fit in RWAs thus far are stablecoins or digital dollars, whatever they are. Some of that is market access, where you might not have access to dollars in your native country. You might be using it for payments, for transfer, as a ledger of who owns what. But really, the exciting thing, the promising thing for the next 5-10 years, and I think where we see a lot of this going, is like actually using these tokens in a way that enables an unlock via these protocols, via platforms like Mantra, via RWA compatible DeFi protocols, shall we say, just not to put too fine a point on it. But really, like you actually just have to use the tokens in order for the tokenization to make sense.
I actually agree with that, and I think one of the reasons why kind of the first wave of tokenization didn't take off is because you couldn't do anything with the tokens, right? First, they just to put things in perspective, when we started the company, there was almost no stable coins. and if tokenization for the most part is issuing securities, which I guess 99% of the use cases end up being issuing a security, one of the advantages is having the securities and the cash on the same ledger and being able to transact with them efficiently, right? Yeah. And the fact that you didn't have stable coins was also a problem for what can you actually do with the tokens. You can't redeem them efficiently. You cannot transfer them and swap them and settle a trade efficiently, et cetera. So I think stable coins, the fact that they grew so much and they're the largest tokenized category is enabling now tokenized securities to start catching up and provide some more utility besides just a better record keeping, which is what was at the beginning, right? So, and then the next wave, as Justin was saying, is DeFi. I think that's more tricky because from a technology perspective, those protocols are great, but they're not designed to deal with assets that require some sort of permission and controls for transfers and things like that. So I think that what I'm excited about it is seeing the next wave of DeFi protocols like what you guys are doing with Flux or others that do start incorporate a more like regulatory approach towards what is the asset that is being put in the protocol, so you can still, transfer it and control it in a regulated way.
Yeah, so it seems like there's two different angles. There's like the access, which I guess is mostly relevant with just dollars today. Then there's like the utility angle. So I guess on like the Ondo side, I feel like you guys are making a big push on getting your tokens spread throughout DeFi. Was it like an initial, was it always part of the early roadmap, or are you saying like how'd you incorporate the DeFi elements into everything you're doing? Because it's clearly hard enough to do just primary issuance. Carlos, that's like, you accomplished this monumental feat of getting BlackRock to issue on chain. How do you do both primary issuance and now getting all your tokens throughout DeFi and unlocking that utility?
Yeah, it's a great question. Just for those unaware, the primary market is when you go to your mutual fund provider and you onboard with them, and then you buy something from, then they give you something, right? And then the secondary market is the buyer goes and sells it to somebody that the issuer doesn't know. And so we were the first asset issuer with any material adoption of a tokenized RWA, a tokenized T-bill. That was OUSG. OUSG is really a permission token. It has an allow list and a smart contract. You have to onboard with us in order for that token to pass from one person to another. Certain clients actually like this. by the way. There isn't like a one token paradigm fits all model. There are a fair number of our clients actually really like the fact that the token can't be transferred to somebody that's not on this allow list. That said, having the allow list has some limitations. You can't freely transfer it to somebody else. There's regulatory reasons for this that we can get into if you'd like. But we relatively quickly realized that even though you could integrate OUSG into DeFi protocols, and it's involved in Flux, it's used as collateral that you can borrow against, it still is pretty limiting. And so for the next iteration of what we were thinking there in terms of an on-chain dollar with yield, we ended up coming up with USDY. So USDY is issued as what the lawyers call a bearer asset, what we in crypto would call a permissionless asset, which means in the secondary market that primary buyer can then, within some constraints around blacklists, around terrorism lists, et cetera, you can transfer that to whomever you want within reason. And that permissionlessness of the secondary transferability is extremely important for others building on top of your thing. So one of the things that we didn't mention about tokenization is this promise of composability, which falls under this broader wrapper of utility, but it's really interesting. It's like, okay, like I've got this token, what can I do with it? And if you have a permissionless token, and that word again is not the best word, but that's what people say.
Semi-permissionless?
When you have a bearer asset, you can do what you want with it, right? Because that token really is the thing, and so you can integrate it within DeFi protocols. You can bridge it from one chain to another. You can build on top of that, and other people can rely upon your token to build on top of it because they know that they can use it in what they're trying to build. So I think that changeover from permissioned to permissionless is a pretty big unlock in terms of other people being able to use that. And so really the structure there came about from a completely different regulatory issuance in the primary market, but it enabled this unlock in the secondary market.
Are you going to see the rest of the issuers kind of following in a similar sort of structural route to make these tokens more permissionless, or do you think just you guys are doing it? Like, what is maybe Carlos? Do you have any plans there?
It depends, right? So they've come up with a regulatory way of doing a. So first, none of these tokens are permissionless. Like even USDC is not permissionless.
Yeah.
So just make it clear. So there's two approaches. One is you move only across whitelisted wallets, or you move only across non-blacklisted wallets, right? But there's both have some controls, because at the end of the day, these are assets that for regulatory and for Bank Secrecy Act and for many reasons, they can actually get into the hands of certain people. And then there's two approaches, right? As I mentioned, like a stable coin, you can send it to anybody as far as that person is not blacklisted. If the token represents a security, it's the other way around, because you need to know who is the holder of the security. Because securities, somebody needs to manage the cap table. If there is a dividend payout, you need to know to whom you're sending the dividend and things like that. So I think there's like the two different approaches. I also think that there is this thinking in crypto that if people have to KYC, nobody's going to use the product. And I remember when I started in the industry in 2016, you could open a Binance account with an email and a password. You didn't have to KYC. And then over time, Coinbase, Binance, Kraken, Bitfinex, everybody implemented KYC for centralized exchanges. And instead of crypto dying, actually crypto grew, because there was more adoption, because people also feel safer and then more institutional people came, etc. So I think DeFi today is completely permissionless and anonymous. And I don't think that this will stay that way forever. I think eventually there will be some sort of on-chain identity that will allow to whitelist wallets and control who transfer what, and that will then make tokenization easier to integrate with those protocols and to be able for those tokens to circulate freely across people.
I mean, I think like that's literally what we're doing, so I'm glad that you think that way.
Can I ask you?
Yeah. I think it's really important to understand kind of this idea between permissioned and permissionless and where our target market is today, or where we see the target market. Like crypto natives are still the people who are buying this stuff, particularly if you're starting to talk about like on-chain products, meaning primarily people who are familiar with wallets, with DeFi, maybe they're pretty avid sex exchange users as well, but they have some crypto knowledge, right? So if you're talking about this market today, they have expectations about the products, they have expectations about KYC, and you need to kind of be able to fit that. And I think one of the reasons it didn't take off historically was because that there's a mismatch between the market and actually what was being offered. Now that we're having this like transition into more permissionless or semi-permissionless environments, I use the term semi-permissionless, I think it's a little bit more accurate. You're seeing a little bit more of a proliferation because you have this ability to have composability of assets across different DeFi protocols. Like the holy grail of being able to collateralize different RWA tokens and then borrow against them is something that will come online in the not too distant future. I mean, I know you guys are even working on it with Flux. So these things are happening. Obviously, it's happening in a little bit of a regulatory vacuum depending on which country you're operating in. I think that's one of the biggest challenges as well. The way that we kind of see the world is basically everything ex-US, at least on the protocol side. And the reason for that is, I'm American, but I live abroad. I want to continually come back to the States and see my family and speak to you guys and whatnot. So we have to make sure that we're abiding by the rules and regulations of the US and the proper licensing requirements here. And if we don't have those, we better stay away. Better to stay away for the time being, right? So in our platform side of it, we have a onboarding process, KYC, whatever you want to call it, that's done via identifying your wallet and connecting it to a decentralized ID, a DID. So it connects to your wallet. It's like this NFT concept, so that when you're online or on chain, you do KYC one time, and then you can onboard into this broader ecosystem. So you're not consistently doing KYC. I think people don't necessarily have so much of a problem in general with KYC. They have a problem with doing it over and over and over again. They're going to KYC for Binance or Coinbase, but if you tell them to KYC for 10 exchanges, they'll tell you to, shove it. So I think this idea of making it as frictionless and as easy as possible, and then really driving just high quality assets to be able to actually tokenize and get exposure to is an important thing that's coming online. It's taking some time. I mean, I just don't think we had these high quality products back in the day. Now you have more things like, literally a tokenized treasury, pretty high quality, I would say. You would imagine at least.
So I don't know if you could get any higher quality than that.
Yeah, it can't be high quality. But in the past, it was like, okay, let's take a, excuse my language, shitty asset and then make it into a shitty shitcoin, and it's not going to make it any better, right? So you need to have both sides, and I think that's getting solved, and all of us are working on it. So,
but look, this is so when the industry started in 2017, 2018, there was this misperception that if you tokenize something, then people are going to buy it just because it's in token
100%.
form, because people were doing ICOs and issuing tokens that people were buying for no reason, just to speculate with it, right?
Yeah.
That doesn't work for an actual RWA asset if you want, because of all the restrictions that are there, and also because typically those tend to be less speculative assets, right? So if you tokenize a building that is going to give you, an 8% yield, it's not very attractive. If you do an ICO that can go 10x in the next 6 months, then people are willing to purchase it, right? So, and then the industry, I think, suffer this, adverse selection problem of, the worst people in the industry coming to tokenize something because they thought that was the way to place a bad asset into the hands of people. I think that what I'm happy to see this time around is that now you have quality people, large asset managers, quality companies, etc., issuing good assets, and those assets are the ones being tokenized. And I see a lot of the same people that also 6 years ago were trying to tokenize bad assets that are now kind of coming back to the industry. But unfortunately now we can say, no, this is a bad idea, you shouldn't do it. Or at least you shouldn't do it with me, go and find somebody else. Because we have other quality assets that we can tokenize that are really, meaningful, and they really add value to the industry.
Yeah, when
also,
does that
the regulatory moat around everything, which I think you've built up pretty spectacularly as well.
Yeah, you mentioned about US versus non-US. I'm actually not American, but my view is a bit different. So if you successfully build a company in the biggest market, that's going to be eventually the dominant company in the world, right? So if you think about, when, social media started, Facebook started in the US, and they were like Facebook clones, starting in every single country. There was one in Spain, there was one in Argentina, every country had a Facebook clone, and eventually Facebook, because it became the dominant social media in the US, eventually became the largest social media company in the world, right? So if you look at capital markets, the US is the largest and most sophisticated, by far, capital market in the world. And then you have Europe, which is smaller, less sophisticated, and extremely fragmented. And then you have the rest of the world, which maybe Japan and and a few other jurisdictions. And then there's a long tail of places like Dubai, or I remember back in the first wave, people were going to Malta or to Gibraltar to get licensed. That doesn't not going to get you very far, because yes, maybe you have regulatory flexibility, but then you don't have customers because those markets are very, very small. So with all the difficulties of the US, I think that the US has something which is the sophistication of the capital markets, and the sophistication of the regulations here is what has made this the largest capital markets in the world. So if we can figure out how to tokenize here, it's going to be a much bigger opportunity than if you decide to abandon the US and go to doing it from Dubai or from Gibraltar, or from Malta, or from places like that.
Yeah. Well, is there any merit, you think, to trying to get started in international markets, potentially as like a wedge to build out the platform, and then hopefully
I don't know, because when you go to those markets, you're going to build something that is not going to work in the US.
Yeah.
Because it's not going to follow any of the regulations the US has, right? So I'm not sure that's of course that might be a way to do it, but my sense is you're going to exhaust the target market fairly quickly, and what you build might not be scalable because might not actually comply with regulations in more strict countries like Europe or Japan or the US.
So I actually do agree with Carlos, and I think on the face you would say, why does John agree with this, considering we're getting licensed in Dubai? But so I'll comment on that too. But I actually do agree with him from a tokenization perspective. The US is the holy grail, right? From Mantra's perspective, the way that we see the world, we're both building the protocol or the actual blockchain that supports tokenization, so a purpose-built L1. We also are building an on-chain exchange that sits on top of it that allows for distribution of assets. And I think the way that we see regulation is that the enforcement happens at the application level, not the protocol level. So, as Carlos was mentioning, distribution of these products, particularly in the US, is obviously happening at at Securitize. It's happening at the actual platforms. Whereas where we come into the picture, like we kind of have this strategy where on the chain side, it's literally just a technology layer. It's a blockchain. So the chain itself can be part of the US. We could integrate with Securitize. I would be happy to. We'll have to have a conversation. And we can, so on that level, it actually makes it like globally accessible. And it's just like whether we're Ethereum or Polygon or Solana or Mantra, like the chain itself can be anywhere. It's global. It's a financial ledger. So it's just a tool for tokenization. On the distribution point, I think the way that we're kind of seeing it, and we just go after a slightly different market, there's benefits to being international first. But we also take a very retail-focused approach. We're trying to make like a mass market consumer application that effectively is actually more targeted towards developing world, which is frankly the people who will probably benefit the most from a lot of these RWAs coming on chain, because in many cases they're underbanked, they don't have access to brokerage accounts, but they do have a mobile phone, they have USDC. They have crypto wallets, and they're pretty digitally native. So we've seen that a lot of these products, maybe their purchasing power is limited, but there's literally tens of millions of these, hundreds of millions of these people who would love to have products like a USDY or tokenized securities or other tokenized real estate, whatever it may be, which could actually make a pretty big difference in their life. Obviously, you got to solve for the regulatory challenges that are there, but we kind of take this approach. I'm not even sure I should say this publicly. Certain markets you ask for permission, not for forgiveness. Other markets you ask for forgiveness, not for permission. So if you have that worldview, you can say, okay, here's where I'm comfortable taking risk, here's where I'm not, and that's
correct. But I think this is why the US market attracts more capital than other markets.
100%.
Right? Because here you have to ask for permission,
you have to ask
not
for
forgiveness. So when you're transacting in the US, for the most part, it's safe, right? When you're transacting somewhere else, you have no clue because the regulator is so small, doesn't have any enforcement power, and therefore people, like what you said, they do all sorts of shenanigans and then ask for forgiveness, and a lot of those things might be illegal, right? So.
You need to bring that degree of trust and accountability that I think hasn't been brought internationally before. We're our biggest investor is backed by 9 sovereign wealth funds. So if we don't act accordingly, my name is mud. So we have to, we emulate what Securitize is doing, what Ondo is doing, and we have to hold ourselves to a certain standard. So if you take the US as best practice and aim to achieve that, which is what you should be doing anywhere, frankly, I think then you're in a better boat than just like, okay, let's just go down to the law of the land.
Yeah, Justin, any thoughts? I feel like you're kind of not just physically in the middle, but legally, structurally, perhaps in the middle as well.
Yeah, I mean, look, the U.S. will eventually get there. There's been a lot of really recent positive developments. Obviously, everybody here is probably quite familiar with the Ether Spot ETF. Not quite approvals, but 99% approved. Some new legislation is making its way through Congress. Promising stuff. But look, I'm an American. I live in the United States. Ondo Finance Inc. is a US-based company. I don't think hey, we operate only offshore but have permissionless tokens is a very defensible stance. We issued our permissionless tokens very carefully in congruence with something that's called Reg S. It's a particularly complicated version of how to create an asset, but effectively you issue it offshore initially, and then after some compliance period, those tokens, if they flow back, it's not the issuer's responsibility. And so we took this decidedly non-commercial approach, is when you come and you mint new USDY from Ondo USDY LLC, which is the separate subsidiary we created just for the purpose of that token, you actually don't get a permissionless token right away because of the regulation. And so, we did not do the ask for forgiveness. We were like, okay, like these are the rules. We know what the rules are. We come from finance. We know what these things are. And it's not particularly commercial to do so, but once the tokens are out there, then they're issued in the regulatory compliant permissionless way. Part of the challenge, though, is that all of these rules around what you can and can't do with how you issue things are this completely, zany, hard to understand, totally non-intuitive thing that people in finance have been doing for a long time. Like the structure that we use to issue USDY has nothing to do with crypto or blockchain. It's just Reg S, which has been around for a very long time. But that said, I think, bringing it back and not rambling too much, like I do think the United States will get there. I do think the United States will be the leader in tokenization and the leader in all these different assets, because really tokenization is just the future of how all these assets are going to be ledgered, first and foremost, and then secondarily, we as an industry, as an ecosystem, need to continue to educate people about why what we're doing is good and why, especially in the RWA space, why it's not that scary, and educate people about things like tokens, about things like wallets, about things like blockchains and bridging and smart contracts and all these different things. And once people understand it, they'll actually see that there's all kinds of positives here. The fact of the matter of like a blockchain being just a better ledger is something that I think a lot of the regulators understand. How to use it safely is still, I think, very much an education point that we're getting to. But if you look at where we are now versus the ICO boom or the STOs from
when you and I met in 2000,
and it's just so much drastic improvement across the board, both from within the industry and without.
Actually, what people don't understand is that tokenization, as I mentioned, for the most part, is basically issuing a token that represents a security, right? That security is either a fund or is a debt product or is a securitized asset, whatever it is, right? So if you look at the US regulations about how to deal with securities, except for national market infrastructure like national exchanges, for the rest, broker dealers, transfer agents, etc., there is zero regulation that talks about what technology can you use. It just doesn't exist. Nobody tells you, like, there is no place I own 2 different transfer agents. There's no regulation that tells me what ledger I need to use at all. It just doesn't exist. So we're in this very unfortunate situation that, because of all the stuff happening in crypto that the regulators are trying to regulate, that percolates down to this part of the industry that has nothing to do with that should just follow existing securities regulations. So it should be able to use whatever ledger you want just to provide a better service, because there's no regulation that talks about what ledger you can use or not to transfer your securities or to record the ownership of your securities or to redeem your securities, etc. So unfortunately, we're in this bad place where the SEC will tell crypto people, oh no, you shouldn't be regulated differently because you use a different technology, but then come to people like us and say, oh, you're using a different technology, let me regulate you differently. It's like, what? So and it makes really no sense. The fact that, for instance, to do custody of tokenized securities, you have to have a separate broker-dealer license and a special one that you need to be, file a CMA with FINRA to get it, just, in my opinion, makes no sense. So.
Yeah, let's talk about the the customers and the clients and all the stakeholders, we gotta make sure we keep those guys front and center. So I feel like there's at least with Biddle, I think the minimum subscription, the minimum investment you have to make is 10 million.
5 million.
5 million, a little bit more democratized. And versus USDY, I believe I don't know what the subscription minimum is, but it is I can buy 1 USDY on Solana like today. So how do you guys think about the various stakeholders and designing products that appeal to a certain market?
I think they are completely different products, right? And with completely different use cases, right? So Biddle, which is the BlackRock money market fund, is basically an institutional money market fund that people can use for 3 different reasons. One, pure on-chain treasury management, because it's on-chain, because you have a token, because we have daily issuance, because we have instant redemption with USDC, etc. So it's fully on-chain. The second is what Ondo is doing, which is built a derivative product that does stuff that maybe we or BlackRock won't do, like better DeFi integration or other use cases, maybe lower minimums, etc. And the third one is collateral management, right? So collateral today is posted mainly on stable coins that are not earning any yield. So for all those 3 use cases, you actually don't need to have a retail product. The intention is not for retail people to earn a 5% yield on a money market fund. So this is why it's institutional. It's $5 million minimum. It's a heavy onboarding process for KYB of the entity, etc. Is it going to stay that way all the time? I don't know, right? So obviously, you can register those funds, make it a 40 Act, and have it retail. But for the time being, that's really where the target is. And in terms of the target, I think the other important thing to discuss is who the target of tokenized products are, right? Because there's potentially 2 universes of people. One is the crypto people, and the other one is the non-crypto people that want access to, assets that in tokenized form are more accessible or easier to distribute or easier to trade or to make them a little bit more liquid, etc.
Do you even give an example of like someone who currently runs a fund and they're like, this Biddle product is, unlocks an extra use case that I wouldn't be able to.
That's us.
Ondo. We're the best example.
We're the biggest client.
We're the largest holder of Biddles.
Yeah, so I agree with you 100%. These are different target markets. Biddle, interestingly, is basically a carbon copy of OUSG. Regulatorily, it's not technically a money market fund, although it's structured to be very much like a money market fund. It's actually a Reg D, 3C7 type fund where it's institutional only. But one of the big unlocks, in particular for Biddle, was in particular the partnership between Circle and BlackRock of being able to redeem into stable coins to be able to get your money out and do something quickly with it. A huge part of what the promise of blockchain and protocols is this unlock of being able to do so. One of the problems with an RWA is you obviously have some sort of tie to the real world and the old world rails, where nowadays the stock market's moving to T+1, treasuries, T-bills, et cetera, sell T+1, money market funds. If you get in early enough in the day, they settle intraday. But that unlock for us of Biddle being able to redeem intraday was a big unlock for our clients. And so we swapped the backing of OUSG from BlackRock's ETF, so the Web 2 fund, to BlackRock's Web 3 version of that, and that enabled us to offer instant mint and redeems for our clients. So I think that part in particular was a huge unlock, and is really very crypto native aspect of this. So when we're talking about distribution and selling these things, a lot of what has failed historically is sort of this lift, copy, and drop of an old world business model onto blockchain rails, and then like you have like shocked Pikachu face, like, oh my God, it's not selling, I don't know why. It's like, you really haven't brought anything to market that's novel, right? Like you actually aren't, like nobody wants that product, right? And so you really need to use the power of the blockchain, things like when we redeem via Biddle, we actually do an atomic swap in the smart contract where we trade out this, we sell the thing under the hood, we get USDC, and it all happens atomically within one riskless atomic transaction, right? That's incredible, right? This is exactly like the power of what we're talking about here. And then, yeah, like USDY is a completely different product where it's really geared towards incorporation within DeFi. So anywhere you have a dollar on chain, I would argue you should use, I don't know if the term yield coin is a thing yet, but a yield coin like USDY stands for US dollar yield, where your money is actually working for you while it's doing something. So so if you're providing liquidity into an on-chain exchange or a DEX like Uniswap, your dollar, while it's there, while it's LPing, is earning interest for you rather than the issuer of the stablecoin keeping all that interest. And that really is just an incredibly powerful primitive that we're starting to see the on-chain liquidity, the DeFi liquidity of USDY getting to the point of, sort of this magic point where we have a lot of clients ask us is, can I get out of $10 million of this right away, with no slippage, et cetera? And we finally crossed that threshold with USDY, where in various different protocols,
DeFi.
Yeah, in DeFi, you have access to that. And obviously, OTC desks and centralized exchanges can back-to-back with DeFi protocols as needed to source their liquidity when a client comes to them.
I mean, maybe just to take a little bit of a slightly more crypto native approach on this, like one of the big customers I would imagine for you guys, or will be for you guys, is also just existing like on-chain protocols that have pretty substantial treasuries in, well, Bitcoin and stables and maybe Ethereum and other different types of token products. Like a lot of these DAOs or other big treasury products, they historically have a lot of their own token, and then they'll like diversify by buying Bitcoin and Ethereum. But basically everything tracks Bitcoin. So like if Bitcoin tanks, your treasury, like the whole thing goes down. So I think a lot of projects, including ourselves, right? Like you want to get different diversified exposure that's uncorrelated to the crypto market, so that you don't have these like wild swings of like bull, bear. Bull market, great, we can sponsor conferences and we can come here and it's all fun. Bear market, like you have to fire a bunch of people and then you're just scraping by. And a lot of that's because of lack of diversified options for treasury management purposes of these on-chain protocols, because they have most of their treasury in token form, right? If you can then have safe, secure, yield-bearing products, whether it's a USDY or in other cases like private credit instruments, which are coming on as one of the bigger use cases that we're seeing, like these are good tools for diversification to make sure that you can maintain your business throughout these kind of volatile market cycles that we've seen in the past. Hopefully that will be less of a thing going forward. But
we are participating on the Arbitrum governance vote to start diversifying. They're starting with a very small amount compared to the size of their treasury. Hopefully that will get bigger. I think in the conference yesterday we talked about, somebody talked about MakerDAO that also started incorporating, like I said, real assets as collateral for DAO, for DAI, which was the initial intention. I totally agree with it, right? Like nobody should manage their treasury on a volatile asset because it's a very risky thing, right? Like you have to end up paying salaries in dollars to people, right? So you want to keep at least a portion of your treasury on something stable, safe, risk-free, and possibly earning a yield as well, especially these days that interest rates are very high, right? So, and then those people want to keep it on chain, possibly on their own chain, which is obviously the more desirable for them, because then they keep more volume happening on their chain, and that's one of the use cases certainly that we're targeting with BlackRock with Beetle, right? And I think the other thing that Justin mentioned is very important. Like people don't understand that the reason a lot of the other money market funds, tokenized money market funds that were out there, if you look at their holdings versus their like rotation, like how many transactions have happened, is they don't move, right? Like people buy them and they leave them there, and then maybe somebody leaves and that never comes back. In Beetle, we have an interesting situation where we have like more than 20 times transactions than actual holders, because people like Ondo or like even us for our own treasury, and we can use Falcon X that is using it for collateral on the prime broker, etc. They actually use it because the functionality of being able to redeem back into USDC and then move back into Beetle, which hopefully the USDC investment also is coming very soon, to be able to move in and out of the money market fund on chain, right? At crypto speed, not at TradFi speed. So.
Yeah, the sales pitch is not sell your Bitcoin and buy treasuries, right? That's not at all what we're trying to say.
For sure.
Almost all these entities live in a world where they have on-chain finances and off-chain finances, and the point is, if you're going to hold a dollar, especially an on-chain dollar, it might as well be a better version of that. And I think of USDY and things like OUSG and BIDL, which are very similar, as really liquid stake dollars, in sort of crypto parlance, where you've got your money, but it's actually, you've lent it to the United States government, they're going to pay you money back when you get about 5.2, 5.3% yield right now. So, I have sort of accidentally gotten about a dozen CFOs or treasurers hired at major crypto entities because they just were completely not managing their treasury at all. And for things like USDY, for the first time, you really have a real claim and redemption rights on your assets. Like obviously the yield is great, but on the other, like, finance is all about risk reward, right? On the risk side of things, the stablecoins 2.0, whatever you want to call it, they're being created and issued with much better guarantees and promises for the token holders on the underlying assets in the real world. So we're still in the early stages of this. We're in the process of various different tokens being audited. We're in the process of getting these things rated by NRSROs. There's all kinds of
ratings agencies.
Yeah, sorry, like the Moody's, Standard & Poor's, et cetera, of the world. And then these are things that real institutional investors basically require in order to get involved in things. And so these are all steps in the right direction, baby steps all along the way. But we're really getting to the point where these products are just significantly better from both a risk and reward perspective than they were even a year or 2 years ago.
Yeah.
Totally. I think that the next thing that has not come yet, at least not in volume or not in quality, is treasury or Fed rate plus products that provide you the Fed rate, which is what most people
the protocols
have
don't support FIT or
but with a little bit more, obviously taking a little bit more risk, obviously taking a little bit less liquidity, but to go from like this 5% more or less yield that all these products provide to like an 8 to 10% without going into doing crazy stuff, right? Like so I'm talking about private credit products and things like that are semi-liquid, that maybe you can do some tricks to make it even more liquid on-chain, and that provide a higher yield, and by taking a little bit of more risk, obviously, than buying treasuries, but it's still safe products, right? So I think that's kind of like the next wave. If you look at treasuries today, I don't think that we need any more people tokenizing treasuries. I think there's plenty of people already. You have, BlackRock plus another couple of large asset managers already doing that. So I don't think that anybody thinking that they can come up with another tokenized treasury product is going to be competitive. On top of that, what we're doing with Circle, between Circle, BlackRock, and us, is very difficult to replicate because of the nature of those three companies, right? The Circle Reserve is managed by BlackRock. We are the BlackRock, transfer agent and tokenization platform. So that relationship, there's no other three companies that can replicate it. So I don't think I think that market will continue growing, but it's pretty much done from in terms of new entrants, if you want. I think if you look at private credit, it's still very immature. Like the quality of the products are very bad. There is a lot of companies that are defaulting on loans all the time because they're like tokenizing a loan to a company in Malaysia that is buying motorcycles, or, weird stuff. So I think that private credit, if you look into traditional finance, is really growing. And the banks are now trying to get into private credit as well. And I think that part has not really trickled down into crypto yet, right? Into RWA space yet. And that's what I'm excited most about the next kind of products. So.
Yeah, so that's on the product side. What about the, I know we just have 2 minutes left, but who are the next set of clients you think are the next segments of clients you think are gonna be adopting these products?
I think for TradFi, people to adopt tokenized assets today, there's still too many barriers of entry. Still issues with wallet management, issue with traditional custodians not being able to hold those assets and stuff like that. I think that, as Justin was saying, integrating better with the crypto ecosystem and figuring out how integrate better with DeFi for these products that have some degree of permissions built in. I think that's probably the next natural way to go for the next 2 to 3 years. But ultimately, that's where you want to go, right? Like you want to make sure that everybody can actually hold tokenized assets, even if you're not a crypto person. But I think it will require still hide the wallets behind the scenes, hide the blockchain behind the scenes, being more adopted by phones and things like that. That today they're not there yet. So.
I mean, on our side, we're obviously it's good that we have a diverse kind of panel here because they kind of cover different parts of the target market.
And you can see all of the data, on our platform.
Yeah, and check out RWA.xyz for all the data. Obviously, we're trying to solve the retail problem, and I think it's arguable that tokenization has achieved pretty ample product market fit at the institutional level. I think JP Morgan has tokenized $1 trillion of treasuries on Onyx blockchain, although that's a permission chain. And there's less than a couple billion of tokenized treasuries on public blockchains. So these guys are working on that. We'll work on the retail piece, I think. Obviously, ex-US for the time being.
Yeah, we've got 20 seconds, so I'm just going to give you a teaser. We announced something called Ondo Global Markets, which is really an approach to tokenizing all of the world's publicly traded assets, so things like stocks and bonds. And the way that we need to do that is in partnership with actual broker-dealers. And it's really a rethinking of what a token really means. You can think of the token rather than a bearer asset, where the token is the asset, as really a messaging protocol where the tokens themselves are really like fractionalized API keys, where you're indicating an intention to sell or an intention to lend via a token deposit into a DeFi protocol, et cetera. So I'll sort of leave it at that. There's more information online, and you can come chat with me afterward, and I'm happy to talk about it. But really, the fundamental question is, how do you bring liquidity to all these assets? How do you tokenize the next 1,000 assets, not the next 2 or 3 assets?
One at a time, yeah.
Undoubtedly, things like all yield products are sort of like T-bills plus something, T-bills plus some risk premia, right? But how do you do that in an operational structure where you bring not just 2 more, but 1,000 more, and do that in an operational way? So I'll stop there. Yeah.
We love scalability. Cool. Well, yeah. Thank you, everybody. Carlos, Justin, JP.
Thank you.
Thank you.